much. And if there are a few more that are still filing in, that's no problem. So welcome, good morning. It's Friday, that's awesome. It is such a privilege to introduce our 8th installment of this series, which has been so successful. We've got lots of really great feedback from chapter members on the EO Exchange series. So we are happy that the feedback indicates that this has been a positive thing for everybody that's adding value, and we're excited to continue to make connections and learn about timely topics. So our schedule today is we'll have from 9:05 until about 9:30 for the panelists to speak. Starting at 9:30, we'll have a Q&A section. So throughout the presentation, feel free to drop any questions into the chat, and I'll try to help moderate some of that Q&A there from 9:30 till about 9:45, at which point we'll break out into small groups and stick around, because after we'll come back and then do a quick recap at the end. So with all of that, that's a quick overview of our schedule for the morning, but let me just introduce our absolutely wonderful group today that's going to be sharing their time and knowledge with us. So this is our panel from Continuum Planning and the City Living Group at Village. We're thankful for these and all of our strategic alliance partners. Andy has been a financial planner since 1999. Graduated magna cum laude from Lipscomb. He majored in finance, economics, and accounting. He's married to Jennifer, involved with the Martha O'Brien Center, and a member of the board of directors for East End Preparatory School, a charter school in East Nashville. Nashville native Abby Spalding founded Continuum Planner Partners, is a Nashville Business Journal 40 Under 40 winner, 2017 Nashville Business Journal's Power Leaders in Finance Award winner, and sits on both the Harpeth Hall Alumni Board and Salvation Army Board. Alumni.
There you go.
Right?
Yeah,
alumni
AE,
board.
Yeah.
Okay, great. We're all learning here. Check us out. Abby is married to her high school sweetheart, JB, and they have 2 daughters. Deborah, with the City Living Group at Village, has a background in global sourcing and working with people across the globe to negotiate contracts worth hundreds of millions of dollars. She is currently on the EO Nashville board, serving as our spousal chair. She and EO member Matt have 4 school-aged children. And finally, Mark has been selling real estate since 1986. He founded Village in 1996, Core Development in 2003, and the City Living Group in 2005. Mark is the former chairman and current chair of governance for ULI Nashville chapter, serves on the Greenways and Open Source Commission, and serves on the Mayor's Sustainability Advisory Board. Mark is the author of 1 Mile Radius, Building Community from the Core. He is an avid juggler, amazing, stamp collector, also amazing, and kayaker. He is married to fellow EO member, Sherry. So you guys, we're so excited again to have all of you have this great turnout. A big part of this is not only the presentation, but also the opportunity to do the Q&A and to connect with other members of our chapter at the very end. So please do stick around. Drop any messages, comments, questions in the chat throughout, and I will now turn it over to our panel.
I think I'm gonna kick us off first on the panel if my memory serves, Deborah. So as he mentioned, I'm Abby Spalding with Continuum. I want to give just a 10-second, 30-second overview of our company, and then we're going to talk way more strategically about how to utilize some assets to access and unlock and grow some wealth. Andy and I are owners of Continuum Planning Partners. We run under the idea that clients want advice more than they want products. And so our clients all pay us a flat fee to do advice-driven financial planning. It tends to work really well with business owners. We like to joke that business owners oftentimes have really great cash flow. Their businesses support the lifestyles that they want. They have a high net worth. They like to invest in tangible assets. They have a lot of real estate. Their businesses are worth something, but they have no money. And so it often allows us to come in and give them a lot of advice and show them how to grow their businesses and show them what to do between now and liquidation, and then what to do if they are able to sell, and how to manage those assets on the backside. But again, we don't have to come in and say buy all of our products and fancy things for us to have a relationship together. Today, we're going to talk a little bit specifically around how to use your assets and use your wealth to be a lot more dynamic. A lot of times what we hear from people, I'm going to turn it over to Andy in here just a second because he's got some things we want to walk through. But a lot of times we hear from people, well, once I put money into that account, that investment account, I never am going to pull it back out. Like, I don't want to use that money. It's over there. Or I really don't want to invest a lot in the market because my competitive advantage is to invest in deals that I see with my friends, real estate, other opportunities, more businesses. And so we found a way, and have been working a lot in the business owner space, to be able to do both and have a lot more flexibility than the traditional model would allow. So Andy, I'll turn it over to you, and you're muted, fair warning.
I've learned. Yep. You're muted is one of the top phrases of this year. So yeah, I'll start with just saying, today's about alternative investments, but we're gonna talk a little bit about structure and then turn it over to the experts on the real estate side of alternative investments to talk through that piece of it. But I wanted to start with just the definition of what is an investment. An investment is an asset acquired with the goal of generating income or appreciation. So that could be stocks and bonds, it could be real estate, it could be Bitcoin, it could be private equity, venture capital, bourbon, art. If you're like me, your bourbon collection that you may have initially bought that for appreciation, and through COVID, it may have been consumed. So it's no longer an investment, it's now consumption. But really, that's what we're talking about is where can you find these opportunities for alternative investments? Because again, to Abby's point, most of the business owners we work with aren't super interested in giving all their money to Wall Street and just sitting back and fingers crossed it's going to work. There is a place for that because that money is liquid. And if you want it back, you can have it back. The challenge with most alternative investments are they're illiquid just by nature. If you're going to put money into a building, you can get your money back, but it might take a little while. You have to go to the bank and loan it. You have to get through a closing. If you're buying into a private equity fund or venture capital fund, those things typically have capital calls, and they have times when you can't access the funds. So typically in the alternative investment side, you're talking about locking money away because there are less buyers of it than a share of Amazon stock. If you wanted to sell your share of Amazon stock tomorrow, there are millions of people that want to buy that from you. You want to sell your private equity fund, you're limited to other holders of the private equity fund who may or may not have any interest in buying it from you. So that's usually when we think about these alternative investments is, from the financial planning perspective, we want to make sure that you have enough liquidity to withstand a downturn and that there's some sort of exit strategy, right? I mean, most of you are building your business, I would think, with the idea of building it to sell. Alternative investments should have some sort of exit strategy as well. So always be thinking about what is that, whether that exit strategy be, getting back to the definition of generating income. I'm buying a piece of commercial real estate or a Airbnb property or something like that. And the idea is that I'm going to pay down that debt over time. It's going to be a cash flowing asset. That to us is an exit strategy. You're turning it into either something that's going to appreciate or generate income. The other side is, as you all ultimately want to be financially independent, which is the term we use instead of retirement planning, because I doubt if anybody on this call will actually retire and go fishing or play golf every day. It's more of, I'm financially independent. I'm working because I want to, not because I have to. Where can we recreate that paycheck? And if everything is in illiquid private investments that I can't get income out of, I have no control over, and they're not liquid, that can be a challenge. And so it's a balance, right? And a lot of times, I'll show you here in a second, we want to come up first with, what's your financial independence number? How much do you need in liquid, safe, boring, income producing investments? And how much of that do you have in dry powder, to where you can go invest in things that are going to get those endorphins flowing, that are going to be exciting to you, but also could turn around and go to zero. Or at a certain time when you need capital, you can't get to that capital. So that's the challenge with alternative investments. So I'm going to first show here. I'm going to show a couple pictures of things. We're big on pictures. They tell 1,000 words. So this is just an example of a situation, and there are a handful of people on here that I see that are clients of ours who have seen something like this with your numbers on it. So this is just an example of one of somebody who their financial independence target is about $300,000 a year of income. So if I had that coming into the household, that would let my family and I do everything we want to do. And so in their situation, we backed into have about $3 million in a diversified stock portfolio that's fully liquid, but growing, some volatility to the market. We could have about $1 million in something safe. In this person's situation, life insurance happened to be the vehicle for them. It's not always the case, but it's a really safe bucket that earns a decent, more than cash, but has no downside to it. And then a big piece in real estate. And this real estate we're talking about is the type of real estate that Mark and Deborah are going to talk about here in a minute. This isn't speculative real estate, because there's a difference in speculative real estate and investment real estate in our mind, where you're doing this to generate capital. You're doing this to generate income, not necessarily just a pop. And then the IRA. So you can see here, this is the income. This big red box is the structural piece, where we want to make sure it's creditor protected. That stands for Tennessee Investment Services Trust. But essentially, in this person's case, we want to identify how much capital you need to be financially independent. And then in theory, every other dollar you have can go into those illiquid, risky types of alternative investments. So first, we want to unlock that. But these buckets also aren't just stagnant, to Abby's point. We want to make sure you can use those. And a lot of times what we help people with is developing what's called a portfolio-backed line of credit. And this is what allows your money to do two things at once. This is where true wealth can be made, where traditionally you see people say, my money is either in cash earning nothing, or I've deployed it to some sort of investment, and there's no in between. Well, how about if we have those dollars invested, growing for you, not, on a scale of 1 to 10, not at a 10 of a risk tolerance, but let's say at a 5, 6, 7 on a scale of 1 to 10, growing, earning your 8 to 10% over time, a lot better than the bank. And you can borrow against it, tax-free, like any line of credit. And typically those interest rates are a lot lower than what you get against real estate lines of credit, because from the bank's perspective, it's a lot easier for them to go get their money back if you default on a loan for a stock than it is for a piece of real estate. So this is where your money can be doing two things at a time. So you borrow against it instead of going to the bank, go do whatever deal it is and pay yourself back while your money is still invested. You don't have to sell it or realize capital gains taxes, and you don't have to sell something while it's down, which is really the only way you lose money in the market. So that's how we have typically helped people unlock money to, let's have some liquidity on the sidelines. Let's do better than we're doing in the bank, yet let's still make sure we as a business owner have access to capital if we need to put it back in the business or an opportunity comes along that we want to jump on. So I know we're moving fast, just wanted to get those ideas out there. Abby, anything to add before we pass over to Malcolm?
The only thing I would add to that is, again, you can see a lot of times when you hear diversification, you oftentimes just think about it in the context of one account. And we really try to move our clients to a much broader definition around tax diversification too. Now you can see we think about tax preferred income, tax-free income, and capital gains income, but also how to use things that may have a capital gains income with a loan against it so you can access it tax-free. Like that's true diversification in liquidity, in different buckets, and then within those having diversification in asset classes. So that's the only thing I'd add before we kick it over to Deborah and Mark.
Awesome, thank you guys. So I am going to share my screen here. It will let me. All right, so looking at investing in Nashville real estate, some of those diversified investments here. The first thing that we do with our clients when they're talking about investing is we sit down with them and we listen to their goals, their budget, their timeline, and really help put a strategy together. And in this market, that's more important than ever, really to sit down with people and make sure that we know exactly what their goals are. So there we go. And our sales team already this quarter, and Mark, if you want to talk a little bit more about that, we've already seen a really strong first quarter. As you know, the Nashville market is pretty crazy right now.
Yeah, what's been happening is that because the market is so crazy and there's so many multiple bid offers on single family houses, a lot of people have been pushing into investments or purchases of new construction. And our team sells a lot of projects for developers, including Core Development, our company. And we've just sold all of those contracts. Those 118 project contracts are on new construction, plus there's a volume in resales. So we're going to talk some about some of the investment opportunities with new construction. I did want to mention, though, that I've worked with Abby and Andy for several years now. When Sherry sold Letter Logic, we got started with them. And then when I sold Village in 2019, before the pandemic, we had some more sit downs, and they're a lot of fun to work with. They're great people. And my investment strategy, we're trying to get to a place where I can buy what's called an inverted Jenny, which is a stamp where the plane was printed upside down. There was only 100 of them made in 1903 by accident. And that's what they're trying to help me achieve since I am a stamp collector. And by the way, my last name is Deutschman, Brandon. I know you were introducing us, and that's a difficult name to pronounce. So back to you, Deborah.
So when we look at how crazy the Nashville market is right now, this slide has a lot of numbers on it, and we're going to drill down in just a moment. But we can pull a report like this for any of the counties in Tennessee in the Nashville area, and then also specifically each town. So like this one is for Nashville. We can pull this report for Brentwood, for Franklin. And if we kind of drill down into those numbers, you can see that single family homes right now, listings are down 30%. The prices are going up. Inventory is down overall about 40%. That's just in Nashville. I know in Franklin, in Williamson County, I want to say it's down 65% right now. To give you an idea, if you know of anyone who is buying a home right now, then you know it's tough out there. Now, when you look at condos in Nashville, you have actually listings have gone up a little bit. Prices have still gone up, not quite as at the same rate as single family homes, and inventory isn't, it's down not even 1%. So overall, that kind of gives you some opportunities there.
Yeah, and interestingly enough, this is a great time if you're looking to, they call it lock and leave, if you want to be able to get to a position where you can lock your door with a condominium and travel and do some things elsewhere. It's a great time to sell a single family house because you're going to sell it for the best price ever. And it's not a bad time to invest in condos, which relatively is a good investment. So some of you might want that kind of opportunity for your personal residence.
We have a lot of buyers looking at second homes now too.
That's true. The market doesn't seem to be slowing down either. We're in a situation right now where we were ranked number 3 in emerging trends through the Urban Land Institute, which I chaired and serve as chair of governance for 2 years in a row. We're ranked number 3 in emerging trends, and it seems like we're ranking number 1 or number 2 in price increases because there's so many people wanting to move to Nashville.
And so, like Mark mentioned, we've continued to rank high on those lists, and it's just seen as a rising star. There's a lot of new construction happening. $4.6 billion in construction permits were handed out last year. And this is where buyers and investors are finding opportunities as well. When the single family market is, the inventory is down 40%, then you're getting into multiple offer situations. People are having to pay well over the list price to get the home. But in new construction, you don't have that issue. The price is the price. And normally you're not going to have a multiple offer situation. We work on a lot of developments, and we sell a property, and then the next buyer comes in and we push them to a different unit. We don't try to sell the same unit and get multiple offers. So also, the earlier you get in on those new construction projects, the more likely you are to have equity at the end when you close, because developers typically will raise prices as they sell more units.
Deborah, give an example of a multiple offer situation you've been in recently and how much the price went up.
Oh gosh. So one that I've been in a couple on the listing side, and these multiple offers, they're going 50,000 above list, sometimes a little bit higher, with escalation clauses, meaning that they'll escalate up to a certain price. They're also foregoing any inspection, any appraisal contingency, because of course it's not going to appraise at that higher price. So they have to take the appraisal contingency out of there for the offer to be real. So I think we've gotten 50,000 above list is kind of personally where we've seen it kind of fall.
I think Danielle, she sold her house in Music Row area and she put it up for $799, and I think it ended up transacting for $880.
Yep.
In about 2 days.
Yep. If you're in, that price point, I think even the one we had a listing that was, a modest $300,000 home, and that went 60,000 above list. So it doesn't even matter the price point right now. And we're now starting to move into Chattanooga area as well, because Nashville inventory is low here, and so there's some opportunities there. Mark can talk more about.
Yeah, so one of the things that I think one should think about when investing is what's an emerging market. And for me, early in investment days, 12 South was an emerging market. We ended up buying 11 properties on 12 South. We ended up in Germantown investing in the Worthen Mills lofts and developing that property and investing and keeping some of those. And then downtown as it happened. So there are neighborhoods and times where something's emerging, and I call it catch up. It's a place where if you buy into this neighborhood and you can feel that the trends are moving in your direction, the market will catch up and equalize with other markets. So it used to be that Green Hills was well more valuable than 12 South, for instance, but over time with people moving back into the urban neighborhoods, that reversed. Well, now you're seeing this in Chattanooga. Chattanooga is well positioned between Atlanta and Nashville, Birmingham, and Knoxville. It's a beautiful city. They call it the Boulder of the South. They've built out an amazing greenway system without even having development. And we're involved with a family down there that's got 120 acres just outside of downtown, right on the Riverwalk. And so we've purchased 11 acres down there, and we're starting to work in that city. in what we think will be a gateway. So I would, we will be marketing product to Nashville from Chattanooga. So take a look when we get started.
Another investment opportunity in Nashville that still remains popular and is now really gaining speed again is the short-term rental market. So people are starting to book trips again. They're feeling more comfortable. They're getting their shots. And I've talked to multiple vacation rental managers who have said that summer is booked. Like, I needed help with a family who got flooded and they didn't have anything available because it's booked. And so we as a team have been selling Odyssey and Alto Contralto, two new construction projects that allow short-term rentals. Odyssey is completely hands-free. Management company is already in place, and you can even choose a furniture package so that they will take care of everything for you. That furniture package includes forks in the drawers, linens, all those things that you need for a short-term rental. So that's still a really exciting opportunity.
Yeah, Odyssey is just ready to break ground, and we were planning on launching it last year during the pandemic, but we decided that short-term rental might not be the best thing to launch, and we encouraged the developer to sell quietly. Well, now we're launching, and we pre-sold 33 units prior to launch because people still want it, and they don't mind waiting a little bit longer. But as Nashville's occupancy and hotel tax starts coming back and people start coming to the market, I think it's a perfect time for a development like this, which is right basically on Parthenon, right over the Parthenon in the West End neighborhood.
Another avenue that a lot of people ask us about are single family, long-term rentals or flips. And right now, just if you were looking at those inventory numbers when I showed them earlier, you can imagine that this might not be something that's easy to find right now. So, I do still have clients looking for flips and single family, but these things are going so quickly, and unless you have cash, really, you're not, you're a lot less likely to be able to win that contract, if that makes sense.
Yeah, and it's gotten a little bit more difficult. The labor market's pretty tight in the construction world, and building costs have gone up significantly. Lumber prices have, I think, tripled since last year at this time. It's sort of crazy. Even in new construction, it's getting a little more difficult to find. We're fortunate we're such a popular city, and that real estate and the dynamic for real estate is fantastic.
So that, I'll hand it back to you, Brandon, and go into the next Q&A.
Awesome. You guys are so timely. Look at that. We're right on time. Okay, awesome. So we've got just a couple of questions in the chat so far. So feel free to fire anything off, anyone that's been following along, or anything else that pops up as we get through this section. So a quick thank you to everyone for sharing with us, and again, for being here. One question that Marty had mentioned is the aspect of leveraging trusts. And I think that's a really interesting topic that maybe we could start off with that one, and just kind of a high level overview of some creative avenues for how to leverage that vehicle.
Yeah, that's, when it comes to investing, it's a lot like business. Well, if you think about the terms of a deal are a lot of times more important than the dollar amount of a deal, because it ends up being the net in your pocket versus the gross amount of whatever the deal is, right? The net is what actually matters. And so using structures, if you remember that the buckets I showed up had the big red box around it that said TIST on it, that's a type of trust. How you own these assets is very important from a creditor protection standpoint, from a estate tax standpoint. Typically, there isn't a whole lot you can do from federal income tax standpoint, but from a Tennessee tax standpoint, franchise and excise taxes are a big deal. I would imagine a pretty good sized line item for most of the people on this call. what types of trust structures can we use either in addition to or in lieu of your standard LLC S Corp structure? And that's one of our forum topics. So some of you, I think Marty asked this because we did this with their forum one time, and I think a lot of them have used this. So, if any of you want us to come talk to your forum about this, we'd be happy to.
Yeah, and I think that traditionally the idea of a trust is this old dusty document that you move something into and then it stays there. And the trusts are a lot more dynamic than that. You can utilize these to purchase and sell things and keep them in the trust, and then leverage that asset to purchase something else. Oftentimes, as you would imagine, it's hard to have something that has leverage against it that is creditor protected. If you think about it from the banker standpoint, you just put an asset in a trust that they can't get to, and they have a loan against it. However, if you work with a really good banker, I haven't seen the participant list, but if Kevin Roddy's on here, he's fantastic. We've worked with him a bunch. If you work with a good banker who understands how to utilize these, you can leverage assets in a trust and just have your trust document state that the banker gets first right of refusal into the trust. They basically can kind of pierce that trust veil. And so you can utilize these trusts way more dynamically than just, oh, I put it in a trust, it's over there and it's done forever. It's just making sure that you understand how to use them and then keep them alive and move money and investments in and out of them.
Okay, great. Elizabeth had also asked a question, and Andy jumped in and kind of touched on it. So she asked, what is the vehicle what's it called basically for accessing your own capital in the line of credit? Andy answered, it's called the portfolio-backed line of credit. Is that a topic that would be like a forum SAP presentation sort of situation? It seems like there's so much packed into the few minutes that you guys shared, and you only just scratched the surface. So is that something that you've done or would be willing to do in SAP forum visits?
Short answer is absolutely. We can go really deep on this topic. High level is, if you really think about it, think about leveraging your house, and particularly in this current interest rate environment. Banks are looking at it and go, okay, you default on your loan, best case scenario, we can liquidate that house and sell it and pay ourselves. The bank can pay themselves back. In best case, 30 days, more likely 60 to 90. Well, a securities-backed line of credit is liquid. It's a market-based security. So the banks or anyone who would be putting a loan against it say, you can liquidate that in 3 days. So interest rates can traditionally be a little bit lower than on a piece of property, which we're all really used to. And so they can be, if your interest rate is lower and you have, to Andy's point earlier, dividends that are kicked out of that portfolio, you can even let that thing pay for itself for a while. So Brendan, yeah, we can go a lot deeper in that topic. And I even think Marla's suggesting breakout. We can talk about it there too.
Okay, yeah, that's totally fascinating. My mind is racing on the math, doing the calculations in my head. That's I think you will likely be coming to visit our forum pretty soon. Okay, so next question from Bert is, what are reasonable expectations for STR yields unleveraged?
So if you're not taking a loan out, then you are looking at, on average, in the, let's say 9 to 15%. That's a really big, wide swing. But really, short-term rental investments, you expect those to net you a lot higher return than like a long-term rental investment. That's why people are so interested in them. So it really depends on the management fees, all of those different things that come into play. I can't guarantee any sort of return, obviously, but that is on average kind of where people are seeing those returns. And what I do with my clients is connect you with a property manager who has that data, who has the years of data, the actual, numbers, and can really illustrate. It's going to depend on if you have a 1-bedroom, a 4-bedroom, all those things are going to come into play.
Speak to the Odyssey, particularly since it's managed, and what kind of return you're seeing in some of the spreadsheets that you've been looking at. And then somebody asked, how much cash would you need to invest in real estate? In order to buy into an Odyssey, what kind of down payment might somebody need?
So Odyssey, we're seeing, obviously the building hasn't been built yet. So these are pro formas, projections based on past numbers. We're looking at 2019 numbers, 2020 is going to be an asterisk in everyone's book forever. So based on 2019 numbers when things were hopping, you're looking around 11 to 12% return. And based on the performance for the Odyssey. And as far as the amount of money it takes to invest, even if you were going to leverage your investment when you go under contract, it's 5% down. So it's, anywhere between about 25,000 to 35,000, depending on the size of unit that you're going to purchase. And what was the other part of that question? Did I answer it all?
Just how much cash would you need to buy it?
Yeah, so that's it. So the money down when you get under contract, that's all you pay down until you close. So depending on what your situation is, if you're leveraging it, then it's just the cash down plus the money to close the loan.
And it's typically, probably as an investor, probably 25% down.
Yeah, for a loan like that. Some of them are doing 15 to 20. People have gotten a little bit, bankers have gotten a little bit more savvy with short-term rental investing in Nashville, and more of them can handle that type of loan now. So it's gotten a little bit competitive to where you can shop that rate around a little bit.
And just continuing on that topic while we're there. So those returns are fantastic. My question would be, with the emergence of more of these managed, complexes, do you continue, or do you foresee those sort of returns continuing in the future, and for how long? And I mean, at what point does it just become too saturated, or the cap rates drop from where they're at?
Right. So there's a lot of different things to look at with that question, those questions. But yes is the short answer. And the reasons why are because with the pandemic, a lot of people had to end up selling their short-term rental assets. And a lot of those sales were for properties that are no longer eligible for a permit. Okay, so it's not like 3,000 properties sold and then 3,000 more are going to come back on the market. Probably 2,000 of those can no longer even get a permit. And so you're not seeing the same amount come back on the market. So the market is still there for the Airbnb property. The traveler still likes to book that way. And then also these management companies have become more savvy. For instance, Goodnight Stay, who's going to be managing Odyssey, they actually, they worked with Marriott. People can book with Marriott points. They market it like a hotel. So let's say a group of 20 was looking for a place. Well, that's going to pop up and they'll allow that group to book, 4 or 5 rooms, but actually units that are going to have a kitchen and a living space for everyone. So it still holds an advantage over a hotel. And the managers, like I said, have become more savvy, and the inventory has actually gone down on the amount of short-term rentals. Where we are seeing a little bit of hurt happening with short-term rental owners is in the 1-bedrooms. So because that is really so closely competitive with a hotel room, and hotel rates are so low right now because they can't get people to stay, right? People are starting to come back, but those rates are so low. It's really hard for that 1-bedroom short-term rental owner to compete with a hotel room right now.
And with the development of those sort of, I guess, complexes, is that something that's becoming more popular nationwide? And do you see more and more of those in the pipeline for Nashville and other cities?
I know there is, I know of one in particular that's coming. It's going to be a more higher end, but the return's going to be lower because it's going to be a more expensive unit. So I do think that you'll see those projects still coming, but they are going to be kept to certain areas because of regulations in Nashville. Mark, you might be able to speak a little bit more to that.
Just a bit. I mean, for us right now, we're seeing people incoming from New York City, Chicago, LA, and quite a bit from Seattle because of Amazon. Amazon keeps adding jobs in the city, and they're not going to all be, and a lot of people will be coming to Nashville and working in Nashville. Amazon's looking to try to find a way to create 30 or 40 or 50,000 room nights with agreements with different complexes to bring people here for a short time to work in our hub at this point. And it does feel like we're still getting a lot of job announcements from other places. And so that brings sort of the executive that might want to come in and stay for a few days. There's scouts. We're also very lucky. We're Music City. I was, as a chair of the Urban Land Institute, when I traveled and met some of my cohorts in other cities, they just could not believe how well branded we are. And so that bodes well for short-term rental in our city. But I am noticing now, traveling to Chattanooga, that the short-term rental market is fairly robust there too. It's a tourist, it's got a tourist thing. It's more outdoorsy tourist, but the short-term rental seems to be popular in that city. I can't speak to it nationwide though. I don't think you'd want to have them as much in Chicago or New York City at this moment. Those dense urban locations, people are looking to come to places like Nashville or Chattanooga.
Okay, so I'm going to piggyback two questions together as our last two, and then we'll jump into breakout. So Samira asked about surrounding areas. So not Nashville proper, maybe not Brentwood, but getting out into Columbia, getting out into Lebanon, Hendersonville. Are those areas inflating at the same rate that Nashville proper is, or are those areas that now are growth targets for the future? And if I can lump this in somehow, Marty asked what the balance is of real estate and other investments. So maybe as we talk about other areas, we can think about what percentage of our capital or our wealth we'd like to allocate to that.
I'm sure Abby and Andy would say that we should put 100% of our assets into real estate, right? They have to control me.
You have to buy stamps. So it's real estate and stamps.
Right. I do think Tennessee is a state that's hugely popular right now, and you're seeing investments from some of these big companies, Facebook, Amazon, et cetera, all over our state. And so I do think Tennessee in particular is playing catch up. There's a lot of cities that are starting to get more jobs, more growth. I can't tell you which ones are better than others at this point, but I do see a lot of announcements every day for places in the surrounds, not in Nashville proper, where, here's another 1,000 jobs. And you have to imagine that the real estate goes up in value when jobs announcements come in.
Yeah, from working with a lot of clients that own real estate in various places in other cities as well. The real estate market's hot everywhere. It's crazy what's going on. I mean, people I think have been sitting at home and looking at Zillow and jumping in things, and it's just, no matter where it is, it's hot right now, which is good and bad. But from a balance standpoint, it's key, and everybody's a little different. So everybody's risk tolerance is a little different. Everybody's income needs are a little different. But just like in most things in life, all of your eggs in one basket is not a good thing. So having 50-50 blend is not likely reasonable, but somewhere in the 70-30, 60-40 blend one way or the other, again, just depending on your risk tolerance, liquidity, and income. But just is key with everybody.
And I would also just dovetail on that, not all investments are equal, not all real estate's equal. So if you have a bunch of real estate that has a really high yield, that's going to be able to pump us up a little bit higher and really long lease rates to say like, yeah, let's expand on this, versus all speculative real estate or real estate that may have a more of an impact on, you know, situational rentals. Cash flow producing real estate, if it has a really high yield, gives us more capacity than not.
Okay, awesome. Thank you guys so much again. So with that, we're going to move to our connection portion of the morning. And